Okay, guys, so as promised, sorry for those technical difficulties earlier, but as promised, I wanted to bring on a lender who can really speak to the kind of lending that some of you are looking for when you're looking to buy and renovate and end up renting out your properties. So I'm super excited to be able to introduce to you someone who I've known for, gosh, I don't know, 3 or 4 years at this point, and he's just one of the most knowledgeable hard money lenders I've ever met, and he really understands our space because he lives it, he works it, he is an investor himself. So I'd like to introduce Chad Chiniquiy from IMC Money. And
Hello,
welcome, Chad.
thank
So
you.
let's just start. Why don't we start by can you tell our group a little bit about yourself, your background, your company, and then we'll kind of just go from there.
Yeah, so can you hear me okay?
I can totally hear you now.
Okay, great. So Chad Chiniquiy, I'm with IMC Money. I'm a hard money lender and an active real estate investor. I got into business in the late 80s, and once I got started and saw the business, I pretty much stuck with it the entire time. It's been pretty good. So I started out as a real estate investor a long time ago, and realized that money was a big component to it was a big barrier. Getting funding was a big barrier to being able to get into the real estate business. So I learned everything about the money business, and in 1993 I started IMC Money. From that time till now, I've funded about $3 billion in home loans for people just like the people that we're talking to right now. I specialize in acquisition and development financing. So I've done thousands and thousands and thousands of loans. I look at 40, 50 deals a day. So I've got a lot of experience in the hard money space. But also, as you said, I'm an active real estate investor. So I flip houses as well. So my day job is a hard money lender, but on the side I flip houses. I've recently flipped a couple here. I primarily invest. I do it nationwide, but my area of expertise is Southern California. I live on the coast here. I just sold a house, just flipped a house, had a sales price of $892,000, and I did another house just recently where the final sales price was 1.3 million with no real estate agents involved, which was a nice little one. I actually paid $1 million cash for that house, renovated it for about 30, 40 days, and then flipped it for $1.3 million with no real estate agent. So that was a good one. So I understand both sides of the fence as a hard money lender and also as an active real estate investor. I've done about $100 million in personal real estate deals. So I don't want to brag and all that kind of stuff, but it's important for people to know that I know what I'm talking about. I'm an expert in this field, both as a real estate developer and as an acquisition and development financing expert. So that's kind of where I come from as far as the investment goes, and as far as the hard money lending goes. And I started working with you. It's actually been closer to 5 years. I know
Oh
you think
wow.
it's. I know.
Jeez.
I
Time
know.
flies.
Yeah, I know. And so yeah, and it's been great to work with you. The thing that I'm most known for is my fix and flip loans. I can fund 90% of the purchase price of a house and 90% of the rehab, so that the borrower only has to come up with 10% down payment. None of my loans have prepayment penalties, and I never ask for tax returns. I never ask for pay stubs or W-2s or anything like that. I really am an asset-based investor, just focusing on the overall value of the property. So that's kind of me in a nutshell. Acquisition and development financing, real estate investor, and I love to help people get in this business.
All right. So Chad, this is so this group is specifically focused on passive income, but in the passive income realm, so as opposed to fix and flip, but in the passive income realm, of course, there's a lot of opportunity for buying fixer uppers. I don't think I've ever bought a house. Even all my rentals were fixers. I always bought them as fixers and then fixed them to become rental properties. So tell me a little bit more. And I was talking to our group earlier today just about that. As time has gone on, more and more hard money lenders have created a space for the rental loans. And I didn't even know that you did that until recently. And you were telling me about one of your loan programs. I was like, whoa, like people need to know about this. So I know you know which one I'm talking about, but can you talk a little bit about that and so that our group knows about that?
Sure. So if you're trying to buy and hold a property, there's basically two ways to go about it. You can just go ahead and do a standard buy and hold loan. And rates are so low right now that you can get an extremely attractive interest rate even on an investment property. The problem with most traditional investment loans is they usually, for investment properties, the down payment's usually between 20 to 30% down. And most lenders will still require some sort of proof of income, a tax return, a pay stub, W-2 or something. That's for more of the traditional Fannie Mae, Freddie Mac investor lender loans. Hard money loans, the interest rates are going to be a little bit higher than the Fannie and Freddie investment loans. But the hard money loans are still really attractive, as low as say 5%, 6%, kind of depending on the market and the region. So rates are still good. The problem with the buy and hold properties is usually people have to put up too much of a down payment, or they have to qualify, or like the rents don't justify it, or something like that. So that's some of the problems we run into. So the program that you and I were talking about was what I call my fixed to rent loan. So as you said just a second ago, just about every property you buy, even the ones that you're anticipating keeping as the passive income, those properties usually need to be fixed up or need some sort of renovation. And the model in the old days was you buy the house, put 20, 30, 25, 20, 25 or 30% down on the house, and then you pay out of pocket to renovate the house.
Yeah.
And the problem with that is it just eats up a lot of your capital and it limits your bandwidth. So, and as you know, the key to this business is your capital reserves. The more you have, the more investing you can do. So what we developed a really attractive program. I call it the fix to rent. And basically it follows the guidelines of my fix and flip loan, whereas we can still fund 90% of the purchase price and 90% of the rehab, up to 70% of the after rehab value. So if you're buying a home for passive income and you think you're going to have to fix it up, more than likely you're buying it a little below, because it's in bad condition or not in perfect condition. You're buying it a little bit below market value. You buy it below market value, you then fix it up, and then you'll build in equity into the property. We used to call it sweat equity when you would work on a house yourself or renovate it. That's the same concept here. So let me walk you through a simple deal. You want to buy a house. Instead of putting down 20% or 25% and then covering all the renovation out of your pocket, come to me. Let's figure out what the property's really worth. We'll buy the property. You put down 10%. I'll finance 90% of the purchase price of the house, and I'll finance 90% of the rehab, so that you only have to put down a total of 10%. And we'll put it on like a regular fix and flip loan that has a conversion option. So my fix to rent loan, what you do is buy the house, fix it up, and then as soon as the renovations are done, then we automatically just convert it into a 30-year fixed rate. Right now, that rate would be about 5% on a 30-year fixed mortgage, and it actually will just revert over. So we don't have to actually go back. The problem is you don't want to have to go back and reclose again. I mean, you can. So a lot of you out there, you're going to buy a house and just fix it up yourself, and then after you renovate it, then you'll get a long-term loan on it. You can do that, but that would be two closings. The closing from when you acquire the property and the closing when you refinance the property. The problem with that is you're paying double closing costs, and a lot can happen in the time that you bought the house originally and then you go to refinance it later, and there could be problems. Whereas if you just do a fixed to rent loan right up front, I'll fund 90% of the purchase, 90% of the rehab. You go ahead and rehab it, get it all done, get it all renovated, and then as soon as it's done and renovated, we just convert it over. It's a real simple, great little loan. I don't ask for tax returns, pay stubs, W-2s. There's no prepayment penalty on it. So if you want to keep that rental house for 3, 4, 5 years, great, then sell it, no prepayment penalty. If you decide, here's another beauty, is if you decide after you renovate it, you take another look at it, the rents aren't what you thought it would be, you want the equity back out of the house, go ahead and sell it then, and then just take the profits and move on to the next passive income property. So you're not locked into some sort of long-term, prepayment. There's no prepayment penalty. So no matter what
That's unusual for the rental loans.
Unusual because I'm able
almost
to
unheard of.
able to take the short-term money that you really, really need and convert it into long-term money.
That's amazing.
Yeah, it's
That's
pretty good.
amazing. So Chad, I mean, I can immediately picture where exactly I was the moment you told me about this. Because
Where were we?
it was about a month, it was not even quite a month ago. And I was on my way to go work with someone who I'm training one-on-one. And I was on the freeway and we were talking and you told me that. I was like, wait, hold up. You mean we don't have to refinance, meaning there's no second closing? Because that adds
Correct.
a lot of cost. And usually you're paying, call it 3 points on the initial loan, and you're going to pay another 3 points and you get another loan. And you said it's not two loans, it's one loan with a little conversion. So there's
Right.
only one closing.
Right. Now
There's a
listen,
lot of
hold on, real
money.
quick on that. Real quick on that. There is a fee. So how it works is there's a 1 point fee, 1 point, when
That's
you
crazy.
actually exercise the conversion, but no separate
But
set
no
of closing costs.
closing. That's
And
great.
if we do the loan right up front, what I usually do, if you know for sure, if you're certain you're going to end up converting it at the end, paying that 1 point conversion fee, I usually knock off about a half a point up front on the original loan. So once we get your final pricing done, I can usually knock off about a half a point on the front end of the loan if I know you're going to be really converting it on the back end. So that kind of helps minimize the cost. So I don't want to oversell this. It's not a free conversion at the end. There's a 1 point conversion fee, but no additional title fees. I don't get a new appraisal. I don't do any of that kind of stuff. I just basically, the file just needs to make sense. The rents need to make sense. And if it does, it just converts. But we do all of that up front. So you'll know up front. Yeah.
Yeah, and I think, I mean, as far as at least people in this group, like, there's not going to be, because this isn't a flipping group. So it's not like, I might flip it, I might rent it. It's, if we're doing it, you're doing it to rent it. Like, you're 100% clear on the exit strategy. And so I think that's something that people would know going in. Because that was the whole purpose of it, was for passive income. So that's a huge benefit. And I just know, because I've done so many properties over time, that when you have to refinance it, the closing costs and the additional points.
Qualification.
I mean, 1 point is nothing.
What happens if something, so you buy the house and then 6 months later you're going, and then what happens? What happens if you can't qualify? What happens if, or you're trying to refinance and they want to see your tax returns, or you're trying to refinance and some sort of lien on the property, or some perfect example, you get some sort of contractor lien, you're in dispute or something. If you've already got a loan and a first mortgage that's converted, you don't have to worry about any of those hassles, any of those problems. How many times have we seen contractor fights or problems or whatever, discrepancies, where then someone ends up filing a lien on a property that holds up the refinance after the rehab's done? Think about that. That rehab is a time for a lot of things that can happen with the title. So it just kind of solidifies it, make sure that the passive income that you're looking for is readily available once the house is renovated. And like you said, here's the other thing I like about it. When you're thinking with a passive income, the cash flow, when you have that hat on, you're going to renovate a rental home a little differently than you would renovate a fixed to flip home. So if you're flipping it, you're going to really be focusing on, maybe a little more decorative things here or there. Whereas when you have that rental passive mentality, you put in a little bit more durable instead of you choosing a softer marble or something, you'll choose a really strong stone or tile or travertine or whatever. You make your decisions based off, okay, I'm going to have this property for 20 years. What's going to be the best bang for my buck on the new cabinets? What's going to be the best long-term solution? Because instead of just flipping the house to someone else and then walk off and it's not your concern anymore, this is going to be your property that you're going to want to take care of. So you can put the kind of a more durable commercial type carpet, a more durable toilet that has a little better warranty, or a few other things you put in differently into a rental property versus a flipping property. It's not a big difference, but that subtle difference can make make your life a lot less complicated down the road as you're dealing with the rental property and the issues that come with owning a property long term.
Yeah, that's absolutely. So something, I don't think you and I have talked about this yet, but so I know there's no prepayment penalty, which is awesome and unusual. Is there, and I know it's a 30-year, so it's a 30-year fixed loan, so it's not a variable. Is there a term?
No, it's a 30-year term. So
is a 30-year term too?
Yeah, so you don't have to pay it off. There's no balloon payment like in 5 years or 7 years or something like that. It's a true standalone 30-year fixed rate. Right now, today, if you were converting right now, if you bought the house 6 months ago, renovated, and you're converting right now, you'd be right at 5% on a 30-year fixed loan. Now, real quick, that's still considered hard money, even though it's a pretty good rate. If you went out and just bought a house and called a mortgage company and you put 25% down as a rental property, you could probably get a rate in the high 3s or low 4s or mid 4s. I'd be higher than that, but no qualification, no tax returns, no pay stubs, no W-2s, no prepayment penalty, investment property in terrible condition, no problem.
That's awesome. Chad, what would be like, so from a qualification standpoint, what do people need to be coming to the table with as far as either them or a partner, credit score, capital? Like, how does someone know whether it's time? Because was just starting to answer questions from the live earlier, and someone had asked that question, what should I be preparing for financially before I bother calling? And you popped on right when I was about to answer that. So can you talk about that?
Yeah, super easy. So looking for a 680 credit score. I don't verify income, but I do want to make sure that the borrower doesn't have any big glaring problems on their credit report, like active things that are going to drag it down below like a 680. I can still do it at 600, but the terms aren't as good and it's a little bit different loan. So I just want you to be thinking in your mind, 680 mid credit score. We pull a full residential mortgage credit report, and the 680 middle score is what we need. As far as qualification goes, again, no income verification, but for the assets, I do need to see that they have assets available. So when they're going into the transaction, I want to see about 20% of the entire acquisition costs. I want to see about 20% of the equivalent of that in cash, checking, savings, IRA, 401k. Example, quick numbers. Purchase price of the house is $100,000. Rehab is $50,000. It's $150,000, and then that passive income house is going to be worth $250,000 once it's renovated. So your all-in costs are going to be $150,000. I'd want to see about $35,000 in the bank to qualify for that with a 680 credit score. Also, must be a U.S. citizen. I love all my neighbors to the north. I love all my neighbors to the south. I can only love the U.S. citizens. So, so if you're a Canadian, which there's going to be some, if there's not now, I guarantee there will be, because a lot of
we actually have people from literally all over the world in this group. I know that there's someone from Switzerland, from India. Yeah, so
I've been doing a lot of loans for foreign nationals lately. The first thing I tell them is get your LLC set up and then add a U.S. partner to that LLC. I have to have a U.S. partner with the U.S. social, and that U.S. social has to also have some assets in the bank. They can't just be a credit score alone. They have to have assets as well, because the deal has to make sense overall. So if I'm going to use a Canadian or a Mexican or an Indian or a Chinese, wherever, I don't care, but I do have to have a U.S. citizen in order to make my loan work. So 680 credit score, U.S. citizen. About 20% of the total acquisition cost of the project in the bank. That could be checking, savings. I can only count your IRA and 401k at about 50% of the face value, unless they are truly liquid. If they're truly liquid, then I can count them dollar for dollar. If you want to know if your IRA 401k is truly liquid, you need to be able to write a check out of it. If you can't write a check out of it, then it's not considered truly liquid, and I can only count it at 50% of the face value. But the qualification process is not that tough. Please remember, I don't loan any money to individuals. I don't do personal loans. I can only loan money to an LLC, a C Corp, something like that. And that's just so that we can actually get the acquisition funds too. So the qualification process is not very tough. Really, all I need is, the same basic documents I need for flipping houses, which is purchase contract, rehab bid, entity documents, bank statements, and identification. That's it. I get your ID. I pull your credit. If you've got the assets, we do an ARV appraisal. I do get my own inspection. Good news on a couple things on the cost on that. I do need to get the appraisal done and upfront, and usually I'll also get, in addition to a regular appraisal, I'll get what's called a comparative rent schedule and a net operating income statement. I have the appraiser do that, just to kind of make sure that your rents are going to adequately, take care of the property. So the deal has to make sense. In other words, if you're buying if you're trying to do a $500,000 loan and the rents on the house are only, $2,000 or something, or the rents have to make sense. That you can't since we're not using your personal income to qualify, the rent has to basically make sense to kind of, contribute towards the towards the payment. And there's a ratio and that kind of stuff. And I can answer those nitty-gritty questions on a case-by-case basis. It's a little better. But the broad strokes are just we're looking for the rents to kind of take care of most of the cost of the first mortgage. So
Gotcha.
just got to be thinking of that. Don't be thinking that you can borrow $500,000 or $600,000 and rent the house out to a buddy for $1,200 and then that would fly, because that wouldn't work. But basically, yeah, it's pretty simple, easy to qualify for.
Okay. And I had just done a financial analysis masterclass last week, and we talked about debt service coverage ratio. So if they've been through that, they'll that will be familiar. So and on the live, I went through like some of the questions that we typically ask when we're interviewing and finding out, and you've answered a lot of them just through this conversation. So you lend 90% of the purchase, as long as they qualify credit score, 90% of the purchase, 90% of the rehab, 5%-ish on the refinance, depends on some factors, but call it 5 or 6% interest rate. What about on the initial loan? What kind of, and I know you said one point to convert, what kind of points and interest and fees would they be looking at on the purchase?
So I really reward for experience if you have acted. So this is remember. So when I'm doing the first loan, there's only one loan. But during the rehabilitation process, when you're rehabbing the house, the rate's a little bit higher on my one-time close. It'd probably be close to 12%.
Okay, that's what I told them is normal.
It'll probably be close to 12. But it's only if you're buying this house.
Couple months.
As passive income to renovate it, it's probably unlikely that you're going to gut the whole thing, that you're going to take 6 months of heavy rehab converting it. I mean, you could, but most of the time when you're looking at the passive income properties, it's more just of the cosmetic stuff or just an update, or things like that. So I don't want people to get freaked out that the rate's going to be, close to 12. It'll for sure be 10. I'll just tell you, it'll for sure be 10. And it's going to vary a little bit depending on experience. If you have tons of experience, then I can work with you on the rate up front. But I don't want anybody to focus on that part of it, because that first of all, that rehab, when the interest rate is up at 12% or 11% or whatever it is, it'll be between 10 and 11. Whatever that rate finally ends up being, it's only for a few months while you're just renovating the house. Hopefully it only takes you 3 weeks, 4 weeks, 6 weeks to renovate the entire house, and then you can convert right at that time. So I don't want to get, yes, you do need to be mindful. There's usually so the loan usually, the one-time close is usually right about 3 points and 12%. And then it converts to 5% interest after the renovation. If you have a lot of experience, if you've flipped houses, like for example, if you've flipped a house in the last 12 months, then I know you know how to do the renovation part of it, then I drop the rate down to 11.5. If you've done more than one property, I drop it down to 11. If you've done 5 properties, I drop it down to 10. So it just kind of depends on experience. But again, that portion has no prepayment penalty. You can pay it off whenever you like. So, maybe you need the money for 3 weeks, just go in and do carpet and paint, new kitchen, new bath, boom, done, and you're out. Then convert it over to the long-term loan.
Awesome. That's cool. And then, what other fees would they expect to
So I need to send 2 people out to the house beforehand. One of them is going to be the appraiser, and you'll pay for that. Somewhere between $400 and $700 is what the appraisal is going to cost, depending on the market. I just had one done today, though. It was $1,000. Appraisers are, but I have no control over that. I have a list of approved appraisers. I go with the approved list. I can't use your appraisal. I have to order my own. So that's one thing that'll be an upfront cost. That's the only upfront cost. The other thing is I do have to have the house inspected, but I send my own inspector out. Now, a lot of you in doing your due diligence, you're going to get your own inspection, and that's great. More power to you. I think it's an awesome thing to do. But I'm going to send my own guy out to the house and get my own inspection. But I pay for it, so I don't worry about that. So no other upfront money. Appraisal is the only money. No application fee, no upfront, nothing upfront, and there's no other fees added on the loan. I mean, I've got a $39 credit report, and then I charge $75 for flood cert, identity verification, tax cert fee, all the other little miscellaneous. So there's no but the big thing is no upfront money, no application fee, No, nothing. Just pay for the appraisal up front. That's what you got to focus on. So that's what I would need up front. Other than that, there's not much.
Awesome. Well, that sounds like an amazing loan. And I know that you have other loans. Oh, I do have one other question. How
Yeah.
many units does this kind of loan work for?
Great question. So this will only work up to 4 units.
Okay, so this is 1 to 4 family.
1 to 4 family. So just remember, good rule, just to always remember, if you're an investor out there, anything from 1 to 4 units is considered residential. Once it gets to that 5th unit, universally, it's considered commercial. So a 5-plex, or like a little townhome that has 5 in a row connected, a little 5 condo thing or whatever, 5 is commercial. 4 or less is residential. If it's 4 or less, it's residential. So 1 to 4 units is what I can do this on.
Very good.
The 4 units are great too, by the way. I just had a guy do this. He's buying this 4-plex for like 160 grand, and he's gonna put like he was gonna put like 5,000 in each one of them or whatever, and he was gonna put down 30%, and then what he was gonna do is he was going to as the tenants move out, he's getting $600 per unit right now. As the tenants moved out, he was going to renovate the units. I said, kick all the tenants out right now. Kick them all out right now. Buy the place, kick them all out. Let me loan you the money. Go in and fix up each unit individually. Raise the rents from 600 to 800 or even 850 because they'll all be brand new, fresh carpet, fresh paint, fresh appliances, all that kind of stuff. Get all that done. Get the rates up to 850. And then I'll do a one-time close. So instead of coming in, putting 30% down on the property and then paying out of pocket each time somebody moves out to renovate it, do it all in one shot. Get your contractor, buy all the property, buy all the refrigerators in bulk, get 4 new refrigerators, 4 new dishwashers, buy it in bulk, go in, I'll loan you all the money. You put down only 10%. I'll automatically convert it into a 30-year fixed as part of the deal. So instead of him coming up, he was going to put down 30%. That was like $45,000 or $50,000 plus closing costs, plus then pay out of pocket for everything. Instead, he's coming up with a total of 20 grand. That's it. 20,000. Buy a 4-plex, convert all the units in that 4-plex, raise the rents on all of them, then qualify for the one-time close, fixed to rent, 20 grand out of pocket instead of about 75 or 80,000 over pocket. And who knows, when's this guy going to move out? And then you're going to go in and try and renovate that, get it all done at once. It's a great thing for multifamily.
All right. So Chad, so if someone was interested in finding out more about your loan programs, if they want to apply or whatever, like what's the best way for them to communicate with you? Or
just remember this, it's imcmoney.com. And if you go there, there's a apply here tab, but there's also like a little question thing right there. Just say, hey, I watched one of Chad's videos. I need some information on this, whatever it is. And that's it, imcmoney.com. Last thing I'll say, and then I know you got to go. We both do. I close these loans in-house. I'm not going to broker this to someone else. So if you do a loan with me, you come to me. I have my underwriters underwrite it. My processors will process it. We'll fund it. We are the ones who do the draws. You put your draw request into us. We take care of it. You make your monthly payment to me. So if you come to the top of the food chain at the beginning and you don't have to worry about it getting farmed out someplace else. So I take care of you start to finish. Chad@imcmoney.com, or just go to imcmoney.com or type in my name, Chad Chiniquiy. You'll figure me out.
Awesome. Chad, thank you so much for spending the time. I appreciate it. And have an awesome day. And thank you again.
Well, thanks so much.
Bye.
Bye.